You good?
I hope so.
Perfect. Good afternoon, everyone. Thank you for being here, taking time out on your Sunday to be here with us on the first nice day in what seems like forever. We really appreciate it, and we're certainly glad to be here with you. Like Andrew said, my name is Patrick Crosby, and this is my colleague Young Choi. And today we're going to talk about taxes for glass artists, how to achieve your best tax position in today's dynamic tax landscape. So we're hoping that this presentation will be informative and that we can kind of shed some light on and elaborate upon a lot of the new tax provisions that were enacted with the Tax Cuts and Jobs Act in late 2017. So we encourage you to ask questions as we go along. We want this to be more of an open table, forum, question and answer discussion, so please do not hesitate to ask in the middle of the presentation. And we provided the PowerPoint to Andrew, so you can follow up with him afterwards and use this going forward.
We'll put it on the website, Jen.
Yeah, thank you.
So a little bit about us. I'm a senior tax accountant. I was born and raised in Rockville, Maryland, right around the corner here. Graduated from the University of Maryland in 2014 as an accounting and finance major. I have 4 years of tax experience at Gelman, Rosenberg, and Friedman, what we call GRF for short, save a lot of time, preparing individual returns, but then also gift, partnership, and corporate returns. And I'm currently enrolled at American University in the Masters of Taxation program.
My name is Young Choi. I'm a tax supervisor at GRNF. I deal mostly with individual income taxes, but I also do taxation for U.S. citizens living abroad. I don't know if you have any of those. But payroll taxes and other state and local taxes I deal with in our firm. I am from Philadelphia. I graduated from Penn State University, and I'm a big fan of the world champion Philadelphia Eagles. Finally won one, so I had to add that in there.
Stop that one on there. So a little bit about our firm before we dive right into it. GRF is located right in downtown Bethesda, right across the street from the Bethesda Metro Station. Since 1981, GRF has provided financial, tax, and consulting solutions that allow our clients to remain focused on their objectives. We serve as trusted advisors to tax-exempt and for-profit organizations, as well as individual taxpayers who recognize our professionals as partners rather than just providers. So we've listed the information here at the bottom, as well as our website, if you want to check us out more. We have over 40 licensed CPAs, and we are a member of CPA America. And we're consistently recognized by companies and organizations such as the Washington Post and Accounting Today as one of the top public accounting firms in the area, as well as one of the top places to work. So we're very proud of that. So diving right in, the tax landscape in the U.S. right now is as dynamic and uncertain as it's been in some time. And this is because of the Tax Cuts and Jobs Act of 2017, which was passed by Congress and signed into law on December 22nd, 2017. So we'll just go over a few of the general basic changes that will affect everybody, and then how they apply specifically to a lot of the topics that you guys submitted to us that you want us to talk about. So the Tax Cuts and Jobs Act was the largest overhaul to the U.S. tax system since 1986, so it was a long time coming. Most of the major individual tax changes enacted by the Act are effective for tax years 2018 through 2025, unless they are extended, which is very plausible that a lot of them will be extended, but if they are not, they will revert back to what they were prior to the Act enactment. On the other hand, most of the changes for the businesses are permanent going forward. So right now, if you've extended your 2017 tax return to this upcoming October, most of these changes don't apply. They're starting in the 2018 tax year, and you'll be filing 2018 taxes in April 2019. So talking about a little bit about the rates. Here we have the old rates, and I apologize that the text is so small, but the old rates and the new rates. There are still 7 marginal tax brackets with a general increase of 2 to 4% in every bracket. The lowest tax rate still remains at 10%. You can see here, these are the old rates, 10% for single and married filing joint taxpayers. Here are the new rates, 10%. But if you look, you see the top rate before was 39.6% for both individual and married filing joint taxpayers, and now the top rate is 37%. So every tax bracket sees a general decrease of 2 to 4%. So just a quick example, if you're an individual taxpayer filing single, you made $80,000 before, you would fall in the 28% tax bracket, and now you would be in the 24% or the 22% tax bracket. If you were a married filing joint filer and you made $180,000 in 2017, under the old rules, you would be in the 28% bracket, and now under the new rules, 2018 going forward, you'd be in the 24% tax bracket. So a little extra money in the back pocket of almost all taxpayers, which is good for everybody. So changes in home pay withholding rates. The changes in these tax rates, the decreases, also affect the amounts that employers withhold on their employees' paychecks. So if you are an employee, you may have noticed that there was an increase in your net pay per paycheck starting in February 2018. And this was due to the decrease in the federal tax withholding caused by these new lower tax rates. So the IRS encourages taxpayers, and we encourage as well, to re-examine your withholding amounts, what we like to call a paycheck checkup, so to speak, to determine if any adjustments need to be made to your new federal withholding amounts in order to avoid any unwanted tax surprises come filing time. You can do this by using the IRS withholding calculator, which will ask you basic income and filing questions to determine whether you have too little or too much withholding being taken out of your paychecks. And we provided a link here below if you want to do that. If adjustments do need to be made, you should submit an updated Form W-4, which, if you recall, is the Employee Withholding Certificate form, which basically just determines how much withholding is taken out of each of your paychecks, and discuss it with your HR representative. And if you are an employee, we really encourage you to do this because you can get more money back on each paycheck and still come out net positive on your tax return come filing time. So exemptions. Out of all the tax breaks that were nixed under the new acts, exemptions are probably going to be the biggest one that taxpayers will miss the most.
Sure. Excuse me, a question about the last slide.
Sure.
Are you going to talk about situations where people are not employees?
Yeah,
Okay.
for sure. A little later in the stage. So personal exemptions, starting in 2018, moving forward, will be completely repealed starting in 2018. This includes exemptions for yourself and for dependents. In 2017, the exemption amounts were $4,500, I believe, yeah? $4,500 per exemption, so this is a pretty big blow to a lot of taxpayers. But what Congress essentially did was they merged the personal exemption into the standard deduction to kind of soften the blow. And I like this picture. It says I listed the federal government as a dependent on my taxes this year, which definitely wouldn't fly, but I think it's funny nonetheless. So the standard deduction was increased, almost doubled, under the new act. Before, as a single taxpayer, the standard deduction was $6,350. Married filing joint was $12,700. Now moving forward, 2018 through 2025 and possibly extended, this almost doubles. Now as a single taxpayer, your standard deduction amount is $12,000. And as married filing joint, your standard deduction amount is $24,000. So this will obviously significantly increase the amount of taxpayers that use the standard deduction. Congress came out and said they expect something like 85% of taxpayers now to use the standard deduction instead of itemized. I'm assuming a lot of people in this room will still itemize, and if that is the case, then this increase in the standard deduction doesn't necessarily have an effect on you. But the large increase in the standard deduction does serve to mitigate the repeal of the personal exemption for those that are going to use it moving forward. So child and family tax credits also increased, which helps mitigate the repeal of the exemptions. The child tax credit increases from $1,000 under the old laws to $2,000 per child. $1,400 of this credit is now refundable per child. And there's an additional $500 non-refundable credit for non-dependent children, that being qualifying relatives. The phase out for this credit is also increased. For single filers, it's now $200,000 before it starts phasing out. And for married filing joint filers moving forward, the phase out threshold is $400,000.
So what does it mean that the credit is refundable?
So credits can be either refundable or non-refundable, and that just means where they show up on the second page of your federal tax return, the 1040. Refundable credits means that if you don't have any tax liability or you make more tax payments than your tax liability, you'll actually get that money back. The IRS will pay that $1,400 back to you, as opposed to just not being able to get the credit anymore, as is the case with non-refundable tax credits. Does that make sense? So changes to itemized deductions. There were a lot of changes to itemized deductions, which will play a large effect in a lot of people's tax returns. First and foremost, the biggest change was the $10,000 limitation, the cap that is now imposed on state and local tax deductions. So this is the Schedule A, the itemized deduction form. And the state and local tax deduction includes property taxes, real estate taxes. You may have remembered back at the end of 2017 calendar year, a lot of taxpayers were scrambling to prepay their property taxes in the hope that they could deduct these taxes on the 2017 return in full, as opposed to having those taxes limited on the 2018 return. The IRS later came out and said, this is allowable, it kind of goes locality by locality. The tax has to be assessed for you to prepay it and get the deduction. Otherwise, you don't technically have the tax liability yet. So it goes by locality. In Montgomery County, they don't assess the 2018 property taxes until midway through 2018. So if you did prepay your property taxes in late 2017, you unfortunately can't get the deduction in 2017. You're going to have to take it on your 2018 return, and it's going to be limited to $10,000. If you live in DC, they pre-assessed, so they assessed the 2018 property taxes in 2017. So if you did prepay them at the end of 2017, then you can deduct them on your 2017 return in full. Charitable contributions, sorry.
Is that total property tax or per property?
So that's total. So your total state and local tax deductions, that's your state estimated tax payments, your state withholding on your W-2, your property taxes, your personal property taxes, all of these taxes, even on multiple residences, combined to add up to your state and local tax deduction. And this in total is limited by $10,000. So this is a huge hit to a lot of taxpayers because a lot of the tax returns we prepare, the state and local tax deduction can be as high as $40,000, $50,000, and now it's being capped.
So that included all property.
Mm-hmm.
Or car
And
tax?
tax on your automobile as well as your.
Well, so this is for non-business taxes. So taxes that you pay for, and you deduct on your Schedule C are not being limited. This is just for your taxes that flow to your Schedule A, your personal itemized deductions.
Good.
Yeah. So your property taxes that don't have to do with your business,
Yep.
real estate taxes that don't have to do with your business, and state and local tax payments that don't have to do with your business.
Good clarification. Thank you.
Good question. So charitable contributions, Young will go more into this later in the presentation. I know you guys wanted us to discuss that. The percentage limitation on charitable contributions used to be 50%. So if you have $50,000 in adjusted gross income, before you would be able to deduct $25,000 in charitable contributions. That was the threshold of 50%. And any excess would be carried over to future years in the year that you can deduct it. Now they've increased it to 60%, so if you make a lot of charitable contributions, this is a little extra tax break. And then the last one I want to talk about is the repeal of the miscellaneous 2% itemized deductions. So this is a section of deductions that you find on the bottom of your Schedule A form. And these deductions include hobby expenses, which we'll go into more specifically, employee business expenses, unreimbursed employee business expenses, tax preparation fees, and then investment expenses. Yeah. And then investment expenses also. So if you have an account with Charles Schwab or Wells Fargo, and you're paying quarterly management fees that add up usually to a significant amount before you'd be able to deduct these, and now they're completely repealed. So I noted hobby expenses here because I know you guys want us to talk about it more specifically, so we're going to get into that now. Hobby loss rules. What is the difference between a business and a hobby? Sure.
When you say business, are you talking about what would be an LLC, or could it be personal business,
Yeah, so it's an LLC, which,
limited liability corporation?
yeah, which if you have a single member LLC, it's called a disregarded entity, and you would report that on your Schedule C. Or just really the more informal version of that, a sole proprietorship, which you would also report on your Schedule C. So I'm referring to both when I say business. And I'll make that distinction a little later as well and elaborate upon it. So what is the difference between a business and a hobby? The principal factor in differentiating between these two is profit objective. Are you conducting the activity to generate a profit? Some other factors: do you depend on the income from this activity for your livelihood? How much time is spent engaged in the activity? Do you have the adequate knowledge and skills to turn this hobby into a business? And then some other factors that the IRS examines in determining whether you have a business or a hobby. The expectation is that the assets you use in the activity will appreciate over time. What success the taxpayer has in conducting other similar activities. And then lastly, the financial status of the taxpayer. How wealthy is the taxpayer? Does he need to be reporting this income as business income? So if you're running a legitimate business but have failed to turn a profit for more than 2 years, you can do one of a few things. You can just stop declaring the losses on your return if you're afraid that the IRS might audit you. Or you can maybe start another business venture and declare the losses on that business venture. A little bit of a risky method, but you can try that as well.
Do you get that 2-year period without profit?
Go ahead.
We need to repeat that question, please.
Yeah, so you asked, do you get that 2-year period? And that's the general rule of thumb, is if you turn a profit in 3 of the last 5 years of conducting the activity, generally you have a business. Now this is not a set in stone, line in the sand rule, but it's a good general rule of thumb. And on the flip side, if you reported losses for 3 out of the last consecutive years, you probably have a hobby. That's how the IRS will probably view it. But it's not always the case, and I will go into that in the next slide or two.
Before you go on, it says how much time is engaged in the activity. What's the rule of thumb for that? 10 hours a week, 20 hours a week, 30?
So I think the rule of thumb for that is about 20 hours a week. It's half of what a full-time job would be.
Do you have to check all those boxes?
The factors?
Every factor?
No. So I'm just going to go into a little bit about each. If you're running a business, be it either an LLC or a sole proprietorship, you're going to report your income and your expenses on the Schedule C, which will flow to your 1040. Business losses are allowed, so
Does everybody know what a Schedule C is?
No. Yeah.
Okay. So you want to explain this?
Sure. So you have your main federal form, that's the Form 1040. You have your Schedule A, that's the itemized deductions form. Your Schedule B, that's where you report interest and dividends. You have your Schedule C, which is where you report your business income and expenses. And I'll list the last 2 most prominent forms. Schedule D is where you report your capital gains. And then Schedule E is where you report rental activity.
So Schedule C is basically for self-employed, if you want to report all your activity on that.
Mm-hmm. So if you have a business, you will report all the income and the expenses on your Schedule C. Business losses are allowed, so if your business expenses exceed your business income, you'll generate a loss on the bottom of the Schedule C, and you can flow that loss to your 1040, and it will decrease your adjusted gross income. If you're running a business and you're receiving earnings, they'll most likely be reported to you on a 1099 miscellaneous form. Not always, though, because 1099 miscellaneouses aren't required for amounts under $600, and they'll be reported as non-employee compensation. business income is subject to self-employment tax in addition to your regular income tax rates. Although half of this self-employment tax is deductible as an above-line deduction. And what I mean by that, an above-line deduction is that section of deductions on the first page of your 1040 form that is above the AGI line, where you determine your AGI. So above the line deductions include moving expenses, half of your self-employment tax, alimony paid, any IRA contributions, and things such as that. As opposed to below the line deductions, which is where you report your itemized deductions, your Schedule A deductions.
Can you define adjusted gross income, please?
Sure, so adjusted gross income is basically the first page of your 1040. You list all of your income amounts, wages, interest and dividends, business income, capital gains, IRA or pension distributions, and then you subtract from that total income your above the line deductions to get to your adjusted gross income, which is the last line of the 1040, page 1.
Can you have this Schedule C and still be also like, I work part-time in schools, so I get a check, so you can have two different.
Absolutely.
You can still declare you have a business.
Yes, ma'am. Any other questions?
Self-employment tax, you're supposed to be taxing yourself?
Believe it or
No
not.
income?
Oh, so if you're not reporting any business income, then no, there won't be any self-employment tax.
But I have an LLC, I employ myself, I get zero income from myself. Am I supposed to be paying a tax to myself for self-employment?
Can I take a shot at that?
No.
Yeah, go ahead.
What the self-employment tax is intended to do is let the government carve out some of the net income you've made. So if you made zero, they don't get any. If you make a significant sum, I don't know where the bottom is, but I think it starts at $1, then the government could come after you for their share of the dollar. Is that correct?
Mm-hmm.
Yeah, so making zero means nothing's owed, either income tax wise or self-employment tax.
So the self-employment tax is kind of equal to the Social Security Medicare tax if you're an employee, and that's how they fund the Social Security in retirement for self-employed people. That's how you get credit for it.
Otherwise known as FICA.
Yes, exactly.
Yeah.
So moving on to hobbies. Hobby income should be reported as miscellaneous income, which is line 21 on your federal return. And this is the last line of the income section on the first page, funneling into the AGI calculation. So hobby expenses are deductible as miscellaneous 2% itemized deductions to the extent of hobby income. So in other words, hobby losses are not allowed as opposed to business losses, which are allowed. You can only deduct your hobby expenses up to your hobby income. So at the best case scenario, you will net out at zero. But remember, like I said, miscellaneous 2% itemized deductions were repealed with the new tax act. So 2018 through 2025 and possibly longer, hobby expenses are no longer allowed. But if you did, yeah.
Even to the extent of hobby income?
Yeah, so you should always report your hobby income, but hobby expenses are not allowed at all anymore.
So we should all start businesses?
Yes. Yeah.
That's what it sounds like.
Yeah.
Let's play with this one for a minute.
Sure, and I am going to go into that. That is the right idea, the right train of thought. You should try and form a business now.
The income here is gross income, not net income, hobby income.
So with hobby income, yeah, going forward, no more hobby expenses are allowed. So you're going to be reporting just your gross hobby income.
So much for selling art. As near as I can tell, that's a radical change for us. I've never heard of that before. So let me just repeat it one time, and maybe you all can correct me if I'm wrong. If I sell, let's say, $1,000 worth of art in a year, and I have $5,000 worth of expenses, I have to report the $1,000 worth of income, and I get no deductions for my expenses.
Correct.
I have Kleenex in my bag. If you That's terrible news.
In the past, in that scenario, you would be able to, you should report your $1,000 of income, and then you would be able to take $1,000 of that total $5,000 to offset the income, but you wouldn't be able to take a $4,000 hobby loss in the past either way.
You guys get out of here alive, it'll be amazing.
It's funny, the only other
I'm
people-
sorry, don't shoot the messenger.
It's funny, the only other people, professions that the IRS treats that way are gamblers, where
Yes,
you have
we
to
are
report all your
addicted.
gambling
We are
income,
addicted to it.
but you
Yeah,
can't,
okay,
your
our
gambling
hobbies.
losses, just like your hobby losses are not deductible now, so you.
I'm gonna try and refine it with another question. I'm looking for any kind of deduction. What about if you donate your pieces of art? I don't wanna talk about how much is deductible, but if you donate pieces of art to a nonprofit?
You could get a deduction.
Okay, we'll get into that. I know
Yeah.
that's coming, so let's just let that wait.
Sure.
Okay.
And that's, just make it clear, that's for hobbies. We're talking about hobbies.
Yeah, we're talking about hobbies. Business expenses are still and always will be foreseeably deductible on your Schedule C.
One other question on
Sure.
that particular. So if it seems logical that we should become a business, even with my $1,000 that I sell per year, if I'm lucky, don't we have to, isn't there a certain number of years where you have to report some kind of profit?
That's what the rate of
3 out of 5.
Yeah, that's the general rule of thumb. In my next slide, we'll really delve into that deeper.
But that's why it's just under a hobbyist.
Hang on, can we,
You don't report anymore as a hobbyist. You don't report your income and you don't report your expenses. Because why should you pay taxes on a loss-making hobby? I mean, that was the last point.
Legally, you need to report your hobby income. You should report your hobby income. You just can't take hobby expenses anymore because they've repealed 2% itemized deductions and hobbies.
Back to the last slide.
Sure.
The last point on the right. Hobby income oftentimes is received more informally and not reported.
No,
Well,
on
on
the
1099.
On the 1099,
That's
this-
different.
yeah, so if you sell somebody a piece of art, you know, a lot of times you're not gonna go generate a 1099 miscellaneous and give it to you, they're just gonna pay you in cash. So unlike if you have a business and you register for a tax ID for your business and a tax name, a lot of times, more often than not, you'll get a 1099 miscellaneous, or at least you should. But as a hobby, sometimes you'll receive the income more informally and there won't be a 1099 miscellaneous in play.
so here's a nasty question. What if we have, we'll set ourselves up as a business, a sole proprietor, okay, we have a tax ID number. We make, I'll use a number, let's say you make $1,000 in a year, and you have $1,500 in expenses, but you only disclose $900 in expenses. You eat the rest.
You fail to capture all the
And
expenses.
there, I'm declaring $100 of net income versus $900. How fraudulent is that?
$100 in net income as opposed to
A loss.
a loss.
Yes.
As originally you said it was going to be a $600 loss.
Yeah.
The IRS usually will not come back and say, hey, you actually had a loss, here's some of your money back. So it's kind of up to you to keep track of your expenses and report them accurately. And if you fail to do so, it most times will be, you know, it will be your loss and the IRS won't come forward and correct you.
Would that, would that example count as one of the 3 years you made a profit?
If you threw out expenses.
Yeah.
You're saying if you failed to capture expenses on your
Yeah.
business? Well, there's not really any way the IRS would realize that you're doing that.
No, but I mean, it showed,
Yes, you would be showing the profit
profit
from one of those
yes,
3 out of
even a
5.
profit of $10 puts you in one of those 3 years.
Mhm. So yeah, so you can tinker with it to get that general rule of thumb to work for you.
They're not gonna, nor should they advise us to do things that are illegal or
Yeah.
inappropriate. but I'm not an accountant anymore or a CPA. And as far as I'm concerned, if you declare money to the IRS, CPA, I saw a number of people who would intentionally throw a small profit to get on the right side of that issue. The IRS is not interested in us. They audit us, and they're not going to get much income out of it, even if they win. They'd much rather audit somebody, you know, a player with legs. But I don't think we should ask these fellows in an open forum whether they would, you know, suggest something like I suggested.
Good one, that's your suggestion.
We'll turn off the video.
Yeah. Turn off the microphone.
We'll look at the source of answers and suggestions.
All right.
So this next slide elaborates on a lot of these questions that we've been going over. And again, this PowerPoint will be made available to you guys. So the classification between hobby and a business is confusing, and it's a bit of a gray area. One thing you should not do is frequently switch back and forth between the two statuses depending on whether you have a profit or loss for that year. This is a red flag for the IRS, who will often view this as an attempt to manipulate the system. So that's one thing you should not do. But the quote-unquote downgrade from a business to a hobby after more than 3 years of losses and 5 consecutive years, it isn't automatic. You don't have to automatically do it. And the IRS may not automatically come forward and provide you with a notice saying that you have to do that and here's more tax you owe as a result. If you run a legitimate business, in your eyes, you run a legitimate business, you're not trying to manipulate the system, you do not have to necessarily switch to hobby status after 3 years of losses. So here are some tips for helping to persuade auditors in the chance that you do get audited, that you are running and building a legitimate business despite consecutive losses. Keep a set of books, general financial statements, preferably using some sort of online accounting software.
Like QuickBooks?
Exactly, yes. Be in compliance with all federal and state regulations, all required licenses, insurance requirements. Keep a mileage log for all automobile expenses to substantiate all of these, or at least an appointment book. Improve your professional skills. Sign up for conferences, classes, and keep the flyers and the registration forms. Advertise, open a separate business bank account, that's usually a big one, and network. So these things will be factors that if you are audited because you had a hobby and now you're reporting it as a business and maybe you've had 3 years of losses and you do get audited, auditors will look at these things, and if you check off a lot of these boxes, they may say, you know what, never mind, you're running a legitimate business and you don't owe more tax.
So the state tax process generally derives from the federal tax process, or at least it's using your AGI and other stuff. Sometimes they're adding something.
Yeah, so that's-
Sometimes not. So what about for Maryland or West Virginia or DC? Anything special to be known about business versus hobby, or how to play this?
Generally, no. The rules are set at the federal level, and then your adjusted gross income from your federal return flows to Maryland, and that's the beginning of your Maryland return will be your AGI, and they'll have additions and subtractions, but I don't believe Maryland has their own set of hobby rules.
No, but if you're doing a business in these states, you want to look into the licenses that are required, and generally there's some kind of fee every year. In Maryland's $300 fee every year to keep your business, if you have an LLC, in good standing.
I just did that, just see about $100 to register, pay $100 in sales taxes.
Shoot. How about Virginia? Anybody?
So a Virginia LLC is $50 a year, registration fee.
Okay.
And I
There's
have a business under another umbrella that I'm
Okay.
rolling glass into. So I'm paying taxes in many ways because it's a legitimate business for architecture.
Okay, and in Virginia, you have to do it by county. It's not, yeah, it's more complicated with counties getting involved in, there's personal property taxes that, you have to pay. you're running a business and doing business in these states. And you mentioned sales tax.
Sales tax.
It's a big
Sales
thing.
tax is by county, and I have Nexus in Maryland, so I'm doing both.
Right. Yeah. But it sounds like you're doing business, so.
For a sole proprietorship, though, it's a little bit different. You do have to register in Fairfax County and get a business license, but you only pay a significant amount if you're making over, what, $30,000 or something. You do have to register with the state, you do have to file your your sales tax returns. In my case, it's quarterly, but I think I started out for a month at a time. But if you don't owe sales tax, you're not paying for anything. So.
Unless you forget to do a
Yes, and then
quarterly,
you owe
and
them
they charge you
$10.
$10.
You still want to file a zero report and may do a sales that money.
Right.
Order.
More questions?
Get gasoline for your car?
Yep.
Do you keep receipts of that, or?
To be safe, yeah. In the,
You
yeah.
can always calculate mileage, can't you?
Yeah, and I'll go into that further, but you can either take the standard mileage rate, which I think in 2018 is 54 cents per mile, or you can take your actual expenses. You can elect to do one or the other, and actual expenses would be gasoline, insurance, registration, rental and lease payments, and so forth.
So my question is about having a separate business bank account, because I'm not passing that much money around that I've done that. Is that gonna get me in big trouble?
I was just going to say, failing one of these things is not going to preclude you from doing this.
So if I'm
These are
doing
just general
most
factors,
of
and
it.
they're going to look at all the factors combined.
And the network, is that networking, or is that something else?
Network,
Meetings.
yeah.
Network.
Meeting people.
Okay,
Yeah.
I just wanted to make sure it didn't mean that I had some sort of specific, you know,
No, I like the
organization.
appointment book, that's,
Yeah.
useful.
Yeah, I
I
use
try
it
it
all
all
the time for my mileage.
The tax year is by default the calendar year, or if you set up a business, or?
It's got to be the same year that you're, yeah, so by default, it's the calendar year.
I have another deviant question. So I unfortunately run a lot of expenses, and I'm thinking that I actually can bifurcate my expenses. I have one set of expenses that has to do with the production and sale of art, and I have a hobby involved in the particular materials and subject matter and courses and whatever. So just how heinous is that? Is that a significant possibility, or is that going to be viewed as smokescreen when I turn my little game?
I would say if you can, you should try to combine these activities all under one business.
That's what I'm trying to avoid.
That's what you're trying to avoid.
Yeah, I'd like to be able to deduct against the income I have and throw off a smaller gain. Right now, I have a huge loss, so the question is I'm going to have a small gain as a result of losing all my deductions. So I'm thinking of shuffling.
Losing all your hobby deductions, right?
Well, I'm not, yeah, exactly.
So if you were to merge these together, you would still be able to take those hobby deductions as business deductions. If you can reasonably and honestly say that these two activities fall under one umbrella of one business. That's what would be most advantageous to you. If that's not necessarily honest, then.
Well, then the question is it still making a gain at some point?
It's going to be how well
This is
you
really
separate these two entities.
Let me say-
You have two different entity names,
Yeah.
you have two different books, you know, the record keeping has to be there, the intent has to be there.
The intent, yeah.
Let me save the question for after.
Okay.
If IRS decided that you were a hobby rather than a business, is there any way to stop taking the depreciation on the studio that you had been taking in the business?
To no longer take the depreciation moving forward? Is that what you're asking? Can you do that? Is that what you're
Yeah,
asking?
can you just stop it?
Yeah, you wouldn't be able to allow to take depreciation moving forward if the IRS does reclassify your business as a hobby, because you wouldn't be able to take the expenses, so you would just stop the depreciation schedules.
Does everybody know what depreciation is? Yeah, we're good. Okay.
Yeah, but I have a depreciation question.
Sure.
So if you're taking part of your home or house as a depreciation against your expense, against your business, when you go to sell the house, does that have to get replaced?
Yeah, that's called depreciation recapture. When you go to sell the house, the depreciation that you took on the house, say using a home office,
Yes.
or if you use part of it as a rental activity, you're going to have to subtract from your basis. Is that correct, John?
You have to add it back when you sell it, so you'll have to pick up that depreciation, that portion of the home office that you took.
Yeah. Let's talk about that after the presentation, because that's a pretty in-depth question. So moving forward, I know some of you wanted to talk about the home office deduction and rules. So we're going to do that here. What constitutes a home office? So business owners can claim the home office deduction if a few stipulations are met. And these are the main two here. First, the office or the workshop space used for the business needs to be the principal place from which the business is run. And it needs to be used regularly. So this doesn't mean that it has to be the only place of business. Your home can qualify as your principal place of business if you conduct administrative or management activities from there. And the second stipulation is the space must be devoted exclusively to business. It doesn't have to necessarily be an entire room. It can be, say, half of a garage for a studio, or it could be even a fourth of the room, a corner of the room. But the limits of the workspace do, however, need to be definitively set. So if you're using this room, you live in this room, and you use this area here, and that area over there, and that area over there, at the end of the year, you say, okay, I think I used about 30% of the room between those spaces, so I'm going to take 30% of the home office now. You can't do that. It has to be definitively set, so like a corner of the room or half of the room or something like that.
Just cage it off.
Yeah. One major exception to this exclusive use test, if you use part of your home for the long-term storage of inventory or product samples, then that doesn't have to be the only reason you use that part of the room then. So what expenses can be included in computing the home office deduction? So the form that you're going to be reporting, calculating the home office deduction and reporting it is Form 8829. And the following expenses can be included on this form. You have your real estate taxes, your mortgage interest, your insurance, be it home, flood, earthquake, repairs and maintenance, utilities, rent, depreciation. Now these expenses above are input onto the form as either direct expenses or indirect expenses. Direct expenses means that they were incurred exclusively for the business space. So think of maybe an installation of a new carpet in the office room. Or you repainted your office room and you only use that room as a workspace. So that would be a direct expense, and you can take that direct expense in full. On the other hand, indirect expenses, think rent, utilities, depreciation. These are expenses that you pay for your whole home, but you have to determine the amount that only applies to your home office. So you do that, you have to prorate them, and you do that by using the ratio of the square footage of the office, of the workspace, to the square footage of the total home. So the direct home office expenses in total and the indirect home office expenses prorated are added up on the Form 8829 to determine your total home office deduction for the year. Now this deduction serves to decrease business profit for the taxable year. And from the Form 8829, it flows to the bottom of your Schedule C. One thing to note is if your Schedule C, if your business already generates a loss, the home office deduction will flow to the Schedule C, but it won't further your loss. It won't increase your loss. It can only decrease your profit. So if that's the case, you have a home office deduction, but you already have a business loss on your Schedule C, the home office deduction just gets carried forward to future years, and you can use it to offset future business profit. So one thing to note, be careful that you're not double counting real estate taxes and mortgage interest, because these two deductions also are itemized deductions that you can input on your Schedule A, if you remember Schedule A, the itemized deduction form. So for example, if your home office space takes up 25% of your total home, then 25% of the real estate and mortgage interest counts as the home office deduction, counts towards the deduction on the Form 8829, and the other 75% of the real estate taxes and mortgage interest count as itemized deductions on the Schedule A. So make sure that you're not inputting those two deductions in full on both forms. Be thorough and be candid when you're tracking and reporting your home office expenses. The home office deduction is one of the more manipulated tax deductions, and in response to the IRS review of the process, oftentimes it's pretty stringent. And then the last slide for the home office deduction is a simplified method. And this is an alternative method of calculating the home office deduction that's much easier than the actual expense method. The IRS allows taxpayers to multiply the area of the home used for business by $5 per square foot. Just a flat $5 per square foot. Now they limit, in this simplified method, they limit your home office to 300 total square feet. So the maximum home office deduction using the simplified method would be $1,500, 300 square feet times $5 per square foot. So this is obviously much easier from an administrative standpoint than the actual expense method for the home office deduction, because it avoids the need to meticulously track expenses throughout the year. And also the simplified method doesn't require you to report and file the Form 8829. The simplified method calculation is done just on the bottom of the Schedule C in one line.
Does that still come off of depreciation of when you go to sell your house? Do you have to add that back?
So if you're taking the simplified method, you're not actually expensing depreciation, so it won't have any implication, or it won't have any effect on the sale of your home when you choose to do so in the future. There won't be any depreciation.
Is that similar to your automobile? If you're using standard mileage, you don't have to wrap that back into the cost of your vehicle when you're
Yeah.
selling?
Yep. If you don't take any depreciation on it, on the automobile, because you're taking the standard mileage rate, then it won't have any effect when you sell the car in the future.
Outstanding. Okay.
Can you say a little more about the thing with depreciation of your house? My house is $100,000. When I go to sell it, if I've been deducting the complicated rate for the home office, do I have to pay the government back for, I don't understand what the deal is.
John, do you want to take the depreciation recapture when you're selling your own?
Yeah, so if you sell it, if you bought it for $100,000 and you sold it for, say, $200,000, you have $100,000 gain, and then you'll have whatever depreciation you took on it. Say it was $20,000, you'll have $120,000 gain when you sell the house. So you'll have to add back your depreciation that you took on.
Yeah, so any depreciation that you took on your home in connection with the home office or the business, you're going to have to add that depreciation you took over the years to the sales price, your home sales price when you sell it, and it will increase your gain. It's called depreciation recapture.
Yep. The IRS is basically giving you a deduction now
And to take it back later.
Yes.
Was there any logic or sort of committee explanation about why hobby expenses couldn't be deducted from hobby income?
Explanation for the repeal of the 2% miscellaneous itemized deductions. I haven't looked into any explanation, but I'm sure you could find it online. I think they're trying to make the standard deduction larger and taking away itemized deductions, certain itemized deductions, so that more taxpayers are going to use the standard deduction. and therefore returns will be more accurate, and it's just less work for the IRS.
So that's where the deduction went into just the standard deduction instead of being itemizable deduction.
I think they were trying to simplify the process, but in some ways made it more complicated.
Classic IRS.
So I don't know if you're gonna cover this elsewhere about amortizing tools you buy. What happens when you're ready to get rid of them? I mean, sometimes I'll donate them to the Guild for the auction or whatever, which is a nonprofit. Do we, what do we do when we get rid of stuff that's been depreciated over the years?
So when you're depreciating tools or equipment for your business, and then you go to sell them, it depends what part of the depreciation process you're in. If it's fully depreciated, then you'll sell it for no gain. Because
If you fully depreciate and you, in that example where you donated it, you've already taken the whole benefit of it. So when you donate it, you're not going to get a charitable deduction for that, unfortunately.
Okay, so you don't take a charitable deduction if you donated every...
If your basis, right, depends on your depreciable basis,
Okay.
whatever's left.
And with the donation, does that go under your, if you had a donation, would that go under your personal donations, or is there a separate one for the business?
No, it all goes on your personal.
Okay, and what happens if it hasn't totally depreciated and you sell it, for example? Or any combination of those things? Yeah. What if you were to sell?
If you sell it, you technically have to pick up the gain on whatever your depreciable remaining basis is and the sales price. So if you bought it for, your tool's worth $100, you depreciated, now it's worth $50, you sold it for $250, you got $200 gain there.
And does that go under income for the business?
It would be under the business.
Okay.
And again,
By donating, you just donate it and you don't claim it.
Right, that's what we would do.
and then again, the charitable deduction, which was an itemizable deduction before, has that been maintained, or that's been changed?
The charitable deduction was maintained. They increased how much you can deduct as charitable deductions,
Right.
which is even more advantageous for the taxpayer. But yeah, they did maintain that, and Young will go more into charitable deduction rules in a little bit. So moving on to LLCs, forming an LLC. So there are two types of LLCs. You have single-member LLCs, you have multi-member LLCs. So a single-member LLC is referred to as a disregarded entity. So the income and expenses of disregarded entities are reported on the owner's individual tax return on the Schedule C and taxed at the owner's personal ordinary income tax rate, because the business income from the disregarded entity is going right into your AGI calculation. Multi-member LLCs, these are partnerships and corporations, be it an S corporation or a C corporation. Partnerships and S corporations will require their own separate business tax returns. The partnership and the S corporation profits flow from these business returns to the partners and the shareholders via Schedule K1. And the profit is taxed on the partners and the shareholders' individual returns at their personal tax rates. So these are called pass-through entities. And this is a term that's being thrown around a lot online and with the IRS these days, because there's a lot of new changes to these pass-through entities that were enacted with the Act. By contrast, a C corporation requires its own business return as well, but there aren't any K-1s issued, and shareholders are only taxed on corporate distributions, think dividends or liquidations when you try to withdraw from the corporation. And C corps are your really large corporations, think Coca-Cola, Apple. So advantages and disadvantages of forming an LLC. The main benefit of organizing your business as an LLC, as opposed to a sole proprietorship, which I will go into a little bit, is the limited liability. Members are not personally liable for business debts. Another advantage, say Glass Art LLC, in the eyes of many potential clients, may hold a more legitimate and formal business feel as opposed to just say the artist's name. The LLC name and the business tax ID, which is called a Federal Employee Identification Number, an EIN, is used instead of your name and your social security number for purposes of payment and so forth, so that can be more secure. And then there's a pretty significant level of ease of use. There aren't many legal requirements or regulations that you have to follow. We were discussing it before, there are some annual fees you have to pay and some hoops that you have to jump through. But compared to a lot of other forms of business, the legal requirements are pretty minimal. A few disadvantages: there's increased administrative work, there's more paperwork and maintenance at the state and federal level. For example, you have to file an article of organization, you have to generate an operating agreement, and in some states, not many, you have to file annual fiscal reports. And then you do have to comply with state and federal regulations and often pay annual fees like we talked about, though these are often pretty minimal.
Do you have the same issues with a S corporation without the LLC on it?
So the S corporation is different. You still have the limited liability, but you have to file. An S corp has to file its own S corporate return, S corporation return, and the income and the expenses that you receive from an S corporation aren't going to go on a Schedule C. You'll receive a K-1 from the corporation, and you report that income in that way.
But if you put the S corporation under the LLC umbrella, you could do that?
Yeah, you could be an LLC, that could be an S corp.
Yeah.
Does that change any?
I'm going to suggest that we ask you to save the question until after we're chewing up a lot of time. I don't think most of us are going to go near an S corp, but
Nobody here's big
you
enough.
should get your answer.
Yeah.
Okay, this is LLC, but we're not a sole proprietorship.
That's my next slide. Or right after this. So quickly, just some procedures, how you would form an LLC in Maryland. It sounds like a lot of you already are using the LLC format. The registration process is relatively easy. You can find free step-by-step guides online, or you can pay a professional service firm to form the LLC for you at minimal cost. This is just an example of the procedures for Maryland. 5 steps: you would name your LLC, you would choose a registered agent who would act as your representative in the forming process, file the articles of organization and the operating agreement, which is required, and then lastly, create the employee identification number. So I put the link here. You can use that website for any of the 50 states to look up the procedures in those states. So now moving on to sole proprietorships. A sole proprietorship is an unincorporated business owned and run by a single individual with no distinction between the business and the individual, the owner, which is contrary to an LLC. The owner is entitled to all business profits and is responsible for all business debts, losses, and liabilities. So in reality, a sole proprietorship is basically just a disregarded entity, a single owner LLC, without the state registration and the various compliance requirements, but therefore also without the limited liability. So you have full liability as a sole proprietor. Sole proprietorships are one of the most popular forms of business in the U.S. due to their administrative and regulatory simplicity. So if you have a business, you've been reporting your income and expenses on a Schedule C all these years, and you're not an LLC, you've never registered to be an LLC, in effect, you've been running a sole proprietorship. Did that answer your question?
I would like to point out the last item there that says one-man control didn't actually mean one man control, one person control.
That's so good.
I'm sorry.
Very
Boy,
politically correct answer.
You are sensitive.
That was a misspelling, it was a W.
Oh, it's nice to find someone sensitive.
Okay, so I know some of you wanted to talk about cash versus accrual accounting and how that relates to inventories and cost of goods sold. So I'll talk about that for a few slides before I hand it over to Young. If you do conduct a business, whether it be a disregarded entity, LLC, or a sole proprietorship, You report your income and your expenses on Schedule C, which I've said a few times. So right up front, the Schedule C will ask you what type of accounting method you're using, cash or accrual. Under the cash method of accounting, you report your income and your expenses in cash, respectively. Most individuals and sole proprietors with no inventory use the cash method because it's just simply much easier to use and to keep cash records. On the other hand, the accrual method, which I'm not going to go into too much detail because it can be kind of complicated, but the accrual method of accounting, you generally report income in the year it was earned, and you deduct or capitalize expenses in the year incurred, regardless of when cash payment was actually received or paid.
Does this mean commitments?
What's that?
When you've committed to receive cash, a contract, or you, like, accounts receivable?
Yeah, so the accrual method uses accounts receivable, accounts payable, deferrals, and accruals.
So that's committed transactions.
Yeah, that's a good way to phrase it. It serves as a placeholder between the cash event and when you've actually earned the income or incurred the expense, the accounts receivable and the accounts payable. And you do that to match the income and expenses in the correct year, or the appropriate year, to most accurately report your business income and expenses.
Like when your product actually ships.
Yeah, yes. So that's how the accrual method works. You're reporting your income and the expenses in the year earned and deducted, not necessarily in the year that the monies were received or paid. And follow up with us after the presentation or via email about this, because this can get a little tricky. So if your business has inventories, or if inventory is necessary to account for your business income, then generally the accrual method of accounting is required. But there is this exception, and it's a big exception, and I would think it applies to everybody in the room here, and it's the $1 million average revenue test. And that is if your average annual gross business receipts, so not your profit, but just the receipts before the expenses.
Oh my goodness, I'm so close to that.
So if your average annual gross receipts for the past 3 years is $1 million or less, you can still use the cash method, despite the fact that you have inventories, which is good news. So if you do pass this $1 million average revenue test, you are not required to account for your inventory using the accrual method. However, this does not mean that you can revert and use the pure cash method either. What it means is that you can account for your inventory, these inventoriable items, as, quote, materials and supplies that are not incidental. This is the term that the IRS uses. And what these are, the materials and supplies that are not incidental, these are the direct materials and the direct supplies that go straight into your product, into your finished product. They're the materials and supplies that are essential and required for the manufacturing process. So the IRS guidance states that you must deduct these non-incidental materials and supplies in the year that you provide them to the customer as a finished good, in the year that you sell them, as opposed to the year that you buy the materials and the supplies.
So, just as an example, if you worked on a piece over and over again, it takes you 3 years to sell, you're supposed to declare the cash expense for the glass in that year 3, rather than in the year 0 or 1 when you actually bought.
Exactly, yeah. So I know that can be kind of confusing, but the bottom line is, if your small business counts towards the $1 million exception, you can use the cash method of accounting even if you have inventories. And if this is the case and you choose to use that adjusted cash method, then you do not have to track your inventory balances or your cost of goods sold. You should deduct those materials and supplies that go into your glass products in the year that you sell the finished good to the customer, and not in the year when you initially purchased those materials and supplies.
That's the adjusted cash method.
Yes, it's essentially a combination method of cash and accrual. But using that combination method, you don't have to track your inventories and cost of goods sold anymore, and you don't have to worry about accounts payable and accounts receivable and accruals and deferrals. So combination accounting methods like this are acceptable as long as the method clearly and accurately represents your income and expenses, and as long as you are consistently applying that combination method. And somebody asked about changing from one method to the other, and if you do desire to do this, to switch accounting methods, you can do so using this Form 3115, which is the application for a change in accounting methods. And then just real quick, some general business deductions. Are you including all of these on your return? So deductions that we see that are often overlooked when preparing a Schedule C, automobile expenses, which we did touch on a little earlier. You can either take the standard mileage rate, which is 54 cents per mile in 2018, and which every year has increased a little bit for inflation, or you can elect to take your actual expenses, which is gas, insurance, repairs and maintenance, rental and lease payments, registration, all of the above. Depreciation. Make sure you're tracking and deducting depreciation on your fixed assets. This is referred to as capitalizing the asset, which is done to better match the expense with the use. Again, that kind of goes towards that accrual method of accounting, as opposed to expensing the entire asset, say equipment that you use to make art, in the year that you purchase it. So just real quick, office furniture and equipment, they have a 7-year depreciation life. Automobiles have a 5-year depreciation life. Common depreciation methods include straight line depreciation, which means you take the same amount of depreciation over the life of the asset, or the double declining method of depreciation, where you kind of front load the depreciation. You take more depreciation in the first few years, and as the life of the asset goes on, you take less and less depreciation. We're not going to go too much into this, but if you want to look into it more, we've provided a link here on the IRS website, which goes pretty in-depth into depreciation lives and methods.
Is there some guideline on when an item of equipment should be depreciated and when it should be reported just in the year that it's purchased?
What's the current rule? Is it $2,500?
Yeah, right now it's $2,500. You can make an election.
Oh, then, under $2,500, you take it in the year.
You can
Yes.
choose either way.
Yes, you can choose either way, but $2,500, you can make an election to take the deduction out.
Okay.
Yeah, in the year of purchase, you can choose to expense it in full if it's under $2,500.
Just to tie the last set of slides together, this all relates to whether one has established business. If one is a hobby, none of this is relevant.
No.
And one may have established a business, a sole proprietorship, but the test about whether it's a business occurs over a couple of years.
Mhm.
So is one basically a hobby until one can have a profit over 3 years?
That's a
Even
good
if
question.
one has,
And it goes back to how the owner sees it, what the intent of the owner is, and to some of the factors that we talked about, keeping books, keeping records, making sure that you're following all regulations. If you start the activity with the intent to make profit, in all honesty, then you can start it as a business. If you just start it and you don't really have the intent to make the profit, and you don't really consider it a business, then it would start off the bat as a hobby. And now you can work that hobby into a business, and you can, I don't want to say downgrade, but you can switch your business to a hobby if you don't feel that you really are trying to make a profit at that point and you reported 3, 4, 5 years of losses. But it's a judgment call that needs to be made by the owner.
And in general, most businesses, it usually takes a few years to get it, running and making profits.
Yeah, and that's why that general 3-year rule of thumb is not a set in stone concrete rule.
But a good way to start off would have a business plan, right?
Absolutely.
I mean,
What happens if after 3 years you do not show a profit? Do they then come back asking for taxes for 3 years?
Can you repeat that, sorry?
Let's say you officially try to be a business,
Mhm.
and at the end of 3 years, you haven't made a profit. Now, I know there's things you might be able to do to mitigate that, but what happens if you do that? Do they then go back and say, oh, well, then we need taxes from you for other things, or?
They can, yeah.
Cross receipts.
Yeah, the IRS can come back with a notice saying you need to downgrade this to a hobby, and you owe X amount of tax. And in that situation, most likely it will result in an audit. And if they determine that in prior years you were really in effect a hobby as well, they'll demand tax for those years as well.
It's not automatic, it's, you really need to just keep good records.
Yeah.
How far back would they go?
3 years is the statute for assessment, so they can go farther back than 3 years.
They cannot or can?
They cannot.
Unless it's intentional, if they determine you've intentionally,
Yeah.
to hide income, then.
So a good strategy to protect oneself from a liability down the road, if one were starting out as a business, but in essence, the likelihood was that it was a hobby, would be at a minimum to pay the sales tax to the state, and it's the state, the federal government doesn't. The federal government, you have to pay income tax on the sales. The state, you have to pay sales tax, I guess, and that's income tax as well. Is that right?
Yeah, you should pay the sales tax. That would help, yeah. So always make sure you're in compliance with the sales tax regulations of your home state, your resident state.
Once you pay the sales tax, you're in essence declaring that you've had income from sale, which means that the income from the sale needs to be reported as income on your federal tax return, and therefore.
Even if you're doing a hobby, you still need to
Even if you're doing a
report
hobby,
it.
you gotta do that. And
Yeah.
therefore, it leads down into your state return.
Yeah, exactly. You should always be reporting your hobby income, even under the new tax law, as miscellaneous income. Not on the Schedule C, but as miscellaneous income. But you just can't report hobby expenses anymore, right? Yeah.
So, do you pay taxes on hobby income? I mean, sales tax? Do you collect sales tax on that? Because if you don't have a tax number, well, I mean, once you.
If you sell something, I think you would.
But if you're
Not
calling,
if you're a hobbyist, you don't need to. Like
if you're
sales
calling it
tax.
a hobby, and you're not going online and becoming a sole proprietorship where you get a sales tax number, and you're selling something,
Well, I
then what
mean,
happens?
If you do a street fair, you can get in Maryland a license just for one event. And you pay a
Oh,
state
okay.
tax for that one event.
Right.
And you
The
don't
state
need to
wants
report
their
it.
cut. The
It's not
IRS,
something you have to
the IRS may not care, but the state wants their
Their
cut.
money, of course.
And that
I never
temporary
knew about
license is
this
only
hobby
good
stuff, so.
For that one
for,
event.
limited time, but if you ask for more than one temporary license during a year, and the state wants you to get out of the temporary license business, and you could declare yourself a sole proprietorship or become another business form or somehow.
So I just went through the sales tax issue for Maryland and Virginia last year and applied. And Maryland told me, I was doing an event in December, Maryland told me, if you're only doing that one event, get the one, it's good for 30 days and it's that one event. Virginia told me it depended on what counties I was selling in, and then they would tell me the rate, and I should apply Virginia sales tax depending on the county. But again, if I only was doing up to 3 fairs, shows
Right.
a year,
Yeah.
I didn't need to do anything. Then I said, well, what about if I have an Etsy site? And then all bets were off. Then basically, that was the trigger, that you
Sure.
just set up all of your items on Etsy with all of the tax states that you have nexus in, and you apply that, and any time you sold on Etsy, it automatically triggered a tax for Maryland or Virginia, because that's where I pay. But if I sold to somebody in California, then I didn't have to pay tax.
yeah, we're actually covering sales tax later.
Okay,
It's a tricky situation, especially when you get into the online sales. I feel states are still trying to catch up to that.
How are we doing time-wise, given what you all have planned?
We should, is this your last slide?
Yeah, that's my last slide. Sales tax and sales tax nexus is a real hot button issue right now. And there's a case going to the Supreme Court, Wayfair, that may overturn the sales tax nexus rules that we've had for the last 20, 25 years and establish economic nexus. Because as of right now, for sales tax, some level of physical presence needs to be established with the state in order for you to be liable for sales tax to that state. But that may change in the next few years to a more economical presence. So it's an in-depth issue, and we can discuss more with you after the presentation, but it is an interesting issue with development happening right now.
Are you going to talk about taxes?
Yeah, we'll have some slides on that, yeah.
And then the last deduction that you may be missing on your Schedule C, the self-employed health insurance deduction. So if you're self-employed, you have a business, you're reporting on Schedule C, you can report the health insurance premiums that you pay for yourself as an above-the-line deduction on the first page of your 1040. It's called proprietor health insurance, self-employed health insurance. And this includes Social Security Part B Medicare premiums and the Part D prescription drug coverage premiums. You can take those Part B, Part D premium amounts from your Social Security and put them on the first page of your 1040 as an above-line deduction, as opposed to putting them on your Schedule A as a medical expense, as a below-the-line deduction, which is more beneficial because on Schedule A they get limited, as opposed to above-the-line deductions, which do not get limited. So if you are paying for your own health insurance, the premiums as a self-employed person are deductible as an above-the-line deduction.
That includes the Medigap.
Medigap, I'm actually not sure about that.
Supplemental.
Yeah.
That's Part B, I think.
Yeah.
If you are not a business, if you are, I'm just curious, can you still take the Medicare? You can't.
It's just a med.
It just flows to Schedule A as a medical expense. And it's more beneficial to have it as an above-the-line deduction because it's not being limited. On Schedule A, medical expenses are limited to 7.5% of your AGI. So they're limited, yeah.
Did that go up?
7.5% of your AGI is subtracted from your total medical expense. It's a threshold. Yeah, so you won't get the full benefit of all your medical expenses. All right, so I'm going to turn it over to Young. I'm going to talk more about charitable contributions and sales and use tax.
So I'm going to be talking about some charitable contributions, and then we'll go into the sales tax questions, and we have a couple slides on the 20% deduction for businesses. A lot of the stuff that Patrick talked about earlier were for businesses, and if you were hobbies, then a lot of that doesn't apply to you. For charitable contributions, a couple things we want to point out. You have to be a U.S. charity. Most of them are 501c3s. There could be some 501c4 organizations, which are social welfare and civic organizations, such as volunteer fire departments, a big one. You can donate to them and get a deduction. Contributions to individuals are never deductible. They're considered gifts by the IRS, and political contributions are not deductible.
Can you set up your own 501c3 nonprofit and then donate your?
You can set up a private foundation. You can set up like a private foundation. I mean, you can set up a C3 charitable organization. It's going to take a lot of work to do that, I believe.
If it helps to frame what you're talking about.
Sure.
The Glass Guild is a 501c3 organization.
Okay.
So we can theoretically accept donations and that kind
And
of
then be
stuff.
treated as tax deductible.
Right. But I do have more questions on that later.
Okay. The big distinction that I wanted to make for you guys is if you're donating artwork, if your glass works, you're the creator versus a collector or investor. It seems like you guys had some questions on this. If you donate a self-created asset, something you created to a charitable organization, your deduction is it says it's the fair market value of the item minus any gain you would have realized if you sold it. Basically, that means it's whatever your cost was in that, your materials, that will be your deduction as the artist.
So you don't get anything for your labor and expertise and skill?
Unfortunately, your time and,
And your brain.
yeah, exactly, that's kind of unfair.
So it's not wholesale versus retail,
Right, exactly.
which is not fair.
Yeah, so, and if this point says if you've expensed the cost already, then you can't take it on your schedule, like you're asking for a double deduction there. If you donate it to a charitable auction, it's still limited to your cost basis as the artist. You know, it doesn't matter what they sell it for, you're still limited to your cost.
You can only deduct how much it cost you. That's it?
Pretty much.
How much the materials that went into the cost.
Right,
What about
exactly.
like the power for the kiln and stuff like that?
Yes, right.
Yeah, that would be an indirect expense.
Good luck, Captain.
Even if you're.
Yeah, exactly.
So even if you're a business, you cannot pay yourself, or it's an implicit wage that's included in the cost of making.
If you're a business,
Yeah, if you're set up as a business, can you then implicitly not include in the cost of making that an implied wage for you as a business owner?
no, unfortunately you can't.
It's
Yeah.
kind of unfair treatment. Yeah.
Yeah, so on
If
the
you were
flip
to
side
hire
of the
someone to do something, like make
Yeah.
a stand or
Yeah.
do cold working, can you get that back?
yeah, you can include all those
Here's the
costs.
specification though. If you've already expensed those costs that went into making that as business expenses in prior years, and, you know, if you hold on to it and then you donate it 3 years later, you'll get nothing. You'll get no deduction for the charitable contribution because you've already expensed those costs, so you can't get it again as a charitable contribution. And you can thank Richard Nixon for this because after his presidency, he donated manuscripts that he wrote to the National Library, and he said, you know, I think these are worth $2 million. So the IRS quickly changed it to, if you're creating something, we can't trust your self-assessment of the value of it. So it's kind of unfair.
Yeah, so you'll notice on the flip side here, we have a collector investor, someone that bought your piece of work. They donated, what do they get? They get the fair market value. Yeah, for a charity, exactly.
So if I make something and I sell it to James, and 3 years later, he can sell it pretty much for what the market value is, which might be $100. Whereas I could only declare, if I held on to it, I could at best declare expenses of like $12 or whatever the plastic's worth.
Right, so yeah, if she's an investor, then she could, collector, she could deduct the fair market value of that piece.
I'm going to take a whack at this as a glass artist who loses money. If you're a hobbyist, and under the new rules as I understand them, correct me when I'm done, you're going to buy some sort of inventory. You're going to buy glass, you're going to buy hooks, you're going to buy stands, you're going to have machinery of some sort that you either rent or you own, which would give you depreciation. There's going to be probably travel back and forth. So you have every cost these gentlemen have mentioned, and you have to be careful about catching those costs. For me, I'm not very hesitant to donate pieces, but what I've just figured out is that I'm in some ways better off donating something and recapturing my costs because I don't get to take my expenses when I sell them, which is new news to me today. Is that correct?
If you're a hobbyist.
Because if you're a hobbyist.
If you're hobbyist.
How many, can I ask a question? How many people are not hobbyists? They're in business. So that's interesting, almost half the room.
With a sole proprietorship, 5 minutes online and you got your tax number and it makes everything less complicated.
Really?
Yeah.
Business liability.
And
And and you can take losses.
Right.
If you make a profit,
Yeah.
If you not, yeah, well, you can do expenses. I personally, off the record, don't like to take losses on my taxes because I don't want to be audited. I'm small fry though, so I'm guessing that'll never happen anyhow, but, my tax guy suggested I do a sole proprietorship years ago, and it's really pretty
Easy.
straightforward. Yeah.
So,
Questions?
so you do charitable deduction and your cash basis business, then I'm in the following year when I finish my product, okay, but I took all the expense because I was a cash business the previous year, so I get, I can't deduct anything or get anything, right?
Right.
All right, so no credit. If I'm on an adjusted cash basis, then what?
If you haven't picked it up, if you haven't taken the expenses, then you could take it as a charitable.
Okay, got it.
I just, Maryland may be easy, I found DC a little more cumbersome to say.
Everything is more cumbersome in DC.
again, as an ex-accountant, I want to go back to what you said. Accrual is really complicated. If you are trying to do accrual, you really need the help of a bookkeeper because, you know, people go to school for a while or work for a long time to understand accrual accounting. You don't want to go there unless you have a really good reason.
So if one is a hobby, if it's a hobby, and one makes a donation of a piece of one's work,
Right.
then to a charitable organization,
Yes.
then that can count as a charitable contribution.
Correct. Up to your
Up
your costs, your
Right.
materials,
And if
other.
one is, that's right, and so, and if one is a sole proprietorship, and one makes a donation,
Right. It would still be the same thing. You don't get the fair market value.
right, but you can deduct some value as an expense.
Sure.
That's
Yeah.
That's an expense.
Whether you can
Well,
take,
you've already deducted the
yeah, whether you
expense,
can
you don't
take
get
the
the.
deduction just depends on if you've already expensed the cost that went into the piece.
Hobbyist, under the new tax law, as a hobbyist, I can't deduct any expenses. So, but I can deduct if I donate a piece.
Yes.
So that's really the only indirect way of,
Yeah,
as a
when-
hobbyist under the 2018 tax law, to get any money.
You got to remember, though, that the charitable contributions are part of the itemized deduction category, and they raise the standard deduction. So, will you get the benefit? You know, we'd have to look at that. Documentation, quickly. Contributions over $250 should get something written from the charitable organization. Over $5,000, the IRS requires an appraisal. You don't really need to attach the appraisal until you're over $20,000. And if you make something over $50,000, the IRS has what they call a statement of value, which you can get some assurance that they'll accept that value. I believe it costs something like $2,500. You pay the IRS and they say, basically, we'll approve that deduction. You can deduct some charitable organizations if you volunteer at a charity. Maybe here you volunteer. You can deduct, let's see, the general charitable expenses must be unreimbursed by the charity, must be directly connected with the volunteer services, and here again, does not include time or services. You can deduct auto expenses for charitable, either out of pocket or the standard charitable mileage rate is 14 cents. I don't know where they come up with this.
$3 per gallon, yeah.
So are you equating a charity with a 501c3?
Yes, any qualified charitable organization.
So if I volunteer my time to gallery sit for a.
Time or service is not included. Sorry.
But your best to get there, you can deduct that, of course.
Yes.
Yes.
What if you teach a class? Charitable travel,
Charitable travel, yeah.
yeah, portions of overall, so I'm volunteering for a week of a 3-month trip.
So I prorate all of the expenses against that week and say that's a direct contribution.
Right.
Is
I see what you're
that
saying.
a reasonable way to?
Well,
do
I think
it?
the IRS is going to say it fails the first test. It needs to be a significant, there can't be a significant personal element to this. So if you're 1 week out of whatever weeks,
Right.
it's not, you're not passing that test.
Okay.
And the charitable work must be authentic and substantial throughout the trip.
So I'm better off just going for a week.
I mean, it depends on where you go. If you're going to Hawaii, I mean.
Just go on the trails.
Gifts. So we define gifts as cash or property transferred to anyone other than a qualified charitable organization. If you gift someone a piece of artwork, glasswork, their basis is whatever your basis was, the gift basis. It's the lower of the gift basis or fair market value. It's basically your basis, or whatever it costs you. Tax rules on gifts, annual exclusion of $15,000 for 2018, $30,000 if you file a joint. Each of you can give $15,000, and that's per recipient, which is nice. Funny thing, upon the death, though, the person who gets your artwork, they can deduct the fair market value instead of the gift market basis. So,
Sell my kids a tax rule on gifts.
yeah,
The,
that's cash or non-cash.
the donor
Mhm.
is making the gift,
Right.
so there's a transfer of value there, and then the donee, person who gets the gift, has to recognize that as income if it's artwork.
No, if it's just, no, they don't have to report it as income. If it's under the $15,000, there's nothing to report to the IRS. If you give someone or you give them cash of more than $15,000, there's a gift tax return they want you to file, just so that they know that you did
But
that.
if the donee were to later sell that gifted art piece, they would have to recognize the income, which would be the difference between what they sold it for and the transferred basis when it was gifted to them.
Next year,
That would be capital gain.
we'll all be selling our work for $15,000 and more since we're
Okay, so basically sales tax, anytime you sell, lease or rent tangible personal property, it's supposed to be subject to sales tax. Obviously this would include any artwork that you guys make, any glass works.
But you have to have a form to charge tax, correct?
Yeah, we'll get to that on the next slides. Basically, you assess it on the gross receipts from the retail sales. Retail sales are made for any purpose other than resale, and you're responsible for collecting it from the customer on each sale. You calculate it, and then you pay it to the state based on the filing frequency. Sure.
So I have actually the same question in two parts. One is if you're in a show and you're not collecting sales tax, somebody else is, because they're not even doing that.
Okay.
You don't have to declare it. Is that correct?
I guess I'm assuming someone else is paying the sales tax, and then, yeah, you're fine. Just as long as someone is getting the
Somebody
sales
else.
tax.
So here's the other thing. If you're in an art show that's sponsored by a charity, and the charity, I assume, is collecting sales tax.
I believe that's the case, yeah. It's the charity's responsibility to collect and remit the sales tax if they're running the show.
Yeah, okay. All right, thank you.
Yeah, it wouldn't be your responsibility. So a big thing that we touched upon is nexus. Which customers are you charging sales tax? In the U.S., you're only required to charge sales tax to buyers in states where you have nexus. Nexus generally just means you have a significant presence in the state. This would include both in-person and online sales. If you are an artist who works from your home or studio, then you might only have sales tax nexus in your home state. It's pretty simple there. But other things can create sales tax nexus. physical location somewhere else. You have a store, front, office, factory, warehouse. If you have people that are like salespeople in different states, that could create some nexus. A drop shipping relationship, like an online sale where you make the sale and someone else delivers it for you, they store it and deliver it for you. That could create a nexus where based on where they are. And art shows or craft fairs, if you sell within their state for just a handful of days, that could create a nexus, and they want their sales tax. So, sales tax in DC, Maryland, 5.75, in DC, Maryland, 6%. They're both destination-based states. If you sell to someone in these states, the rate is where the item is being delivered, as opposed to Virginia is an origin-based state, where everyone in your state is, you're charging them sales tax from where you are located. And the different sales tax in Virginia, Northern Virginia and Hampton Roads has an additional 0.7% sales tax, making it 6%. That includes Alexandria, Fairfax, and all those other Northern Virginia.
I'm a little confused, so I'm in Maryland.
Okay.
I sell somebody something to someone in Virginia.
Right, you don't have nexus in Virginia, so you wouldn't charge them sales tax.
So they don't get any sales tax at all?
Correct.
So I don't charge my Maryland rate and give it to Maryland, even though?
No.
Okay.
If you're shipping it, if someone comes to you and they buy it, if you're shipping it to Virginia.
Oh, if you're shipping it.
Right.
But if they come to, if they
If
walk.
they come to
into-
you, you're doing Maryland.
Okay.
You're doing Maryland.
Okay, I was confused, yeah.
When are these taxes payable?
When are they paid?
When are they payable? Right.
It's different filing frequencies. It's really how much sales you have. Generally, they're quarterly.
Twice a year.
Yeah.
Yeah, I mean, sometimes, yeah, exactly. It's really, there's a dollar threshold where each state has, and that determines if you pay monthly, quarterly, semi-annually in these cases.
I have almost similar question to Sherry. My studio is in Virginia. I live in Virginia, but I can drive to Maryland to sell someone something.
You drive to Maryland to sell something, okay?
Well, if you're doing shows in Maryland,
No, it's not a show. It's a guy who lives in
then
Maryland.
you're just delivering to Maryland, but you're still selling in Virginia.
Yeah. So what is this nexus thing?
Yeah, I mean, in your situation, I wouldn't charge sales tax, because you don't have nexus in Maryland.
And then you have.
You only charge sales tax if you have nexus.
So
Like she's delivering it,
Virginia
she's
and
delivering it
registered
herself.
space in
What are the
Maryland,
times,
so that
please?
gives me nexus.
So we'll go
It's
to,
confusing.
yeah, it's really confusing.
It's very nuanced, and it varies state by state. So it'd be very beneficial just to make sure that if you are crossing state borders, to make sure you do your research so that you stay compliant with these sales tax requirements. But it is very nuanced.
Yeah, we will need to know what kind of activity it is you're doing in all these states,
And
stuff like
the
that.
IRS and the federal government are working to simplify. They are trying to simplify sales and use tax procedures, but as of now, we're stuck with what we have.
Yeah. So quickly on this, you guys might know better than I on this art shows and craft fairs. DC, you requires that sellers file and remit sales tax electronically after the special event is over. There's a place where on there, if you're doing a special event, you can pay it after it's over. I couldn't determine, if you see in the other 2 points there, Maryland, if you participate in 3 or more events each year, then they want you to get a permanent sales tax. Same thing with Virginia. I couldn't get any answer out of DC on that one.
Well, DC doesn't have answers.
Exactly.
DC is only confusing because I have done sales tax in all 3 of those, because I've done shows in all 3 of those jurisdictions, as it were. And DC, once they get your name, they never give it out. I mean, I've been reporting 0 income for DC for, 10 years. I've filled out a form twice now that says I'm no longer doing business in DC. And they still, you know, we're threatening you, and if you don't pay whatever sales tax is owed, I go, owe any sales tax? We will figure it out for you.
And they'll charge you $10.
The moral is don't do business
Yeah,
in
yes,
DC.
whoever is knowing DC likes to pull in.
One other thing about sales tax, they have like a resale certificate. Generally, if you don't want to get charged sales tax, there's a certificate of resale that you can get, or you can provide to the seller. It prevents tax from being charged multiple times on the same item. Sales tax is intended to be applied to the end consumer who will actually consume or use the artwork. I believe the artists, you know, if you purchase items, you know, for your use in your production, like raw materials, you should be able to get a exemption on the sales tax.
Yeah.
Okay,
But over
everyone's familiar.
$200.
Yeah, you have to spend
That's in Maryland.
In Maryland,
In
yeah.
Virginia, they don't have that.
But you can go back and deduct what you were in here.
Yeah, so, question, is it only raw materials, or again, do tools count in that?
I think if your tools are, you know, you need them to get into, you know, to build your final product, I think
Yeah,
it should be
tools
okay.
that you use to build your final product, tools that you use in the manufacturing process, count as well.
Okay, good.
Tools as in machinery, or, I mean, I know that my picture frames count and hooks and display things, but if I'm using a kiln to make it, how much of that can be deducted?
That, yeah, I don't know about a kiln because you're going to be using that over and over again, and it's not just one finished product there.
Right.
Oh,
That's what I'm saying. If you put a picture frame around it, if you create a
Okay.
metal display or something, all of
but
that.
not the saw that you
But
use to
not
make
the saw that you
the-
use to, right.
Huh.
And I just noticed that shipping charges, DC, they charge sales tax on shipping. Maryland and Virginia, they treat it the same way. It's not taxable, but it has to be separately stated on your invoice. You don't have to charge sales tax on that. This is the last topic we're going to discuss. This is more for businesses. One of the new tax law changes was the 20% pass-through deduction. It's called the pass-through deduction, but it's misleading because it's really any business that's not a C corporation. So if you're a sole proprietor, partnership, LLC, you can get a 20% deduction starting in 2018 from your federal income taxes. So on the bottom there, just an easy example, if you have $100,000 of QBI, qualified business income, which we'll describe in the next one, you can potentially get a $20,000 deduction there, starting in 2018.
So is that instead of,
Could you go back? to-
individual deductions?
This is an additional deduction, so with the new tax law changes, they reduced the corporate tax rate down from 35 to 21%.
So my business doesn't have to pay as much.
Yes, exactly. So in response to that, they said it was unfair that the C corporation was getting all the benefits, so they threw in this 20% deduction for everyone else to reduce their taxes.
Can I ask you a few technical questions?
Sure.
So there is this thing called a qualified business income pass-through deduction. Is that going to be applied on the Schedule C or the
I believe
applied
it.
on the A?
I believe it's a below the line deduction. So nothing has been finalized yet on where everything's going to go, but right now we believe it's going to be where the exemptions are. So on the return, so it'll be after your
Adjusted gross income?
after your adjusted gross income as a below the line deduction of 20% that you get to
But
take.
before exemptions, I mean the qualified deductions that you get, if you have like contributions and interest and
Right.
taxes and things.
It would be after that.
After that.
Yeah.
That's what we're presuming, but.
Right, exactly.
No forms have been finalized or released yet, so, can't say for sure.
Yeah.
And
But-
it's 20% of your net
Yeah.
Qualified net business income, yeah.
Yeah, so QBI is going to be the net income of pass-through businesses after all business deductions have been claimed. You get to treat it separately for each trade or business. So just a quick example here.
Yeah, this is one of the biggest, if not the biggest, hot button issue with the new tax law. And it's being discussed and argued and been broken down by tax professionals over the last few months. And the IRS is still coming out with guidance for this new deduction. So this is really something that if you have a sole proprietorship or you're filing a Schedule C, you want to pay attention to this because it can result in a pretty big deduction, 20% of your total business income, if you choose to elect to
So
stay.
hang on a second, I'm gonna run some numbers, table numbers. $1,000 worth of income, $500 of expenses. I have a $500 net income, and apparently I get a $100 deduction against that. Down outside of the Schedule C, it's not part of all these other expenses for getting things done. So essentially, it's a give back from losing all the hobby expenses that you might have.
You can see it that way.
But so it also applies to, if you have other income as well. It would apply to any rental properties that you would have. You get a 20% deduction there. Estates and trusts. So it's wide range, anything but a C brokerage. So here in year one, taxpayer has QBI of $20,000 from qualified business A and qualified business loss of $50,000 from business B. In year one, you get a net business loss of $30,000, so you get no deduction on the 20%. In year two, you have $20,000 from A and $50,000 from B. You get $70,000 total, but you reduce that by the $30,000 carryover business loss, so you get 20% of $40,000.
So can you
Year
just,
two.
I'm sorry, can you run through the various things this might apply to? We know it applies to our hobby income or our.
No, it wouldn't apply to hobby income, it would be business, it's just qualified business income.
Qualified business income.
Yeah,
Right.
So business from your, or business income from your LLC, from your sole proprietorship, from any rental properties, from any pass-through entities, being partnerships and S corps. And then also estates and
trusts.
What about things like if you get royalties from someone, does that count?
I think that should be deductible for 20% royalties. Okay, but there's a bunch of limitations and phase outs here on this qualified business income pass-through deduction. If your taxable income, it really determines, there's two factors here that determine the limitations. It's your taxable income, and it's going to be what kind of business it is. If your taxable income is less than those amounts, $157,500 for single or $315 joint, there's no limitation. There's a phase out once your income gets bigger on the taxable income, and then once you exceed those limits, it's zero, unless you're if you're a specified service business in excess of those amounts, then it's zero, unless you're not a specified service business, and then you jump through more hoops here to get the deduction. So we'll do this. We have some examples that it's very complicated.
Is that the overlap between the personal side and the business side, or is that only on the business side on the previous slide?
On this slide right here?
Yeah. So it's, for instance, it says no limitation taxable income less than $157,500. So
Right.
that's on the business side?
No, that's
On the
taxable
personal
income is
side.
your personal taxable income on your 1040. So you include your business and all other activity.
So in this case,
Your-
you've got a business established, there's a tax situation on the business side,
Right.
you've also got an income side as a person.
You have other income, your wife might have income.
Right, and so this is where the business side and the personal side overlap.
Correct. That's correct. So I just want to point out what a specified service business is. It's any trade or business involving performance of services in the field of health, law, accounting, performing arts. And the main thing I want to point out here is that they put in some ambiguous language at the end. It said any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its owner or employees. I mean, that could apply to any business, I think. So they put some great language in there. So if you are a specified service business, if you are one of those, your taxable income exceeds the 207,500 or the 415, you do not get a deduction. If you're any of the businesses that are not defined here, then you do get a deduction, but there's more hoops you got to go through. The 50% of W-280 and some depreciable property, 2.5%. It just gets complicated once you get in there. I have some examples. Quick diagram that we had. If it's a specified service business, yes or no, and say you are one, and then your taxable income is over the full phase out, you get no deduction. If you are not one of those, and you get to the higher taxable income limitations, there's more of that big brown box and more hoops you got to go through to get the deduction.
Can I ask a question?
Sure.
On the previous slide?
Sure, I know.
The final, no,
This
not
one?
that one. The final version includes language that excludes architects? How does that affect me?
Well, this is good. This is good for you. So,
Okay, that's what I wanted to hear.
so for some reason, the specified service business, I guess the lobbyists for architects and engineers, they got them to not include them in this definition, which means they're not subject to the taxable income limits here, like the rest of them.
I can make as much money as I want.
That's right. So we're just going to go through some quick
The first two examples.
Yeah, this one's just a sole proprietor. I'll go over the examples that have the sole proprietors. We have Taylor, married, sole proprietor, has $100,000 net business income from her bagel shop. Taylor and her husband have $34,000 of other income and will take the standard deduction. So if you see here, her taxable income is $110,000, which is below the $357 for the married couple joint. So she'd get a 20% deduction on her net qualified business income of $100,000. So she'd get the $20,000 deduction. Sole proprietor who's above the phase-out ranges, Jack, married and sole proprietor, has $1 million net business income from his custom motorcycle shop. Jack and his wife have $50,000 of income and $60,000 itemized deductions. His taxable income is $990,000, which he's out of the range there for a deduction for the phase out, but he's not a specified service business, so he gets the lesser of 20% of his business income for his taxable income. So that's what they were trying to show you here, that if your taxable income is less than your net qualified business income, you only get the lesser of that 20% deduction there. I'm not going to go into any of these other slides unless you want this S corp and stuff. So that's
Yeah, it's how the deduction relates to S corps and partnerships, but Andrew, I think you mentioned that not many people are involved here with S corps or partnerships.
They haven't done that yet.
So that concludes our slides. Sorry,
Yeah, so we included our information here, both of our email addresses and the number that you can reach for our office. If you guys want to follow up with us, discuss anything further, we can work with you and hopefully provide more answers for you moving forward with anything.
Yeah, our business cards are up.
Yeah, our business cards are up here. Thank you so much for having us.
They would be happy to take more questions if you have them. And don't forget the business cards, so you can call yourself. So I learned things.
Oh, good.
It's on the table.
we're all learning things nowadays. It's, it was a big overhaul.